how anyone can start investing. Now, maybe you heard from investing from a friend, maybe you heard about the crazy GameStop craze that was going on and this huge short squeeze and lots of Reddit people going crazy making a bunch of money, or maybe you learned about investing from seeing Tesla on the news and seeing how they're revolutionizing all the automobile space. Now, regardless of how you learned about it, today we're going to be discussing everything all the way from the base, from what is a stock to where you should buy it and everything that surrounds that, how to start investing, and everything that surrounds the topic of investing. So let's hop right into that and let's go. I hope you enjoy. So hi, I'm Kevin Castaneda and this is Kev's Mindset, and here we talk about finance, investing, mindset, and productivity. And today, as you know, we're going to be talking about the basics of stocks and how you can begin to invest in them. So let's get right into what exactly is a stock. Okay, so what exactly is a stock? Now, a stock is a small piece of a company / corporation, and we're going to use Apple as our example just to give a brief understanding. So you go to the company Apple and you go onto your broker, which we will discuss later, so don't worry about that for now. You go onto your broker and you decide, I want to buy one share of Apple. Now, one share of Apple is approximately $130. So you go and you buy your one share of Apple, which means you own $130 worth of Apple, which that is current pricing right now, just clarifying that. And so now that you have that one share of Apple, no, you can't go to the Apple store and say, I own part of you, give me free stuff. No, of course not. But what you can do is you can see, hey, I own part of this company. What is this company doing? Do I like what they're doing? Should I keep putting money into this company? And now this is very important because it gives you a level of power over your finance. And although you don't directly impact what the company is doing, you can still invest in what they are doing if you do believe in them in the long term. And we'll discuss different versions of investing later on. But let's assume this company has a dividend. Basically, what a dividend is a small piece of money that the company decides to pay out to those who invest in the company. So let's say Apple decides that they want to pay $1 million in that year for dividends. So now you owning one share of Apple are entitled, we're gonna assume that you own 1% of the whole company, just to make it a little simpler. So let's assume you own 1% of the entire company of Apple, right? And Apple decides they're gonna pay out $1 million worth of dividends this year. So every quarter, which a quarter is a 3-month period for a company, where each quarter they take out their earnings and they tell the shareholders how much money they made, what they lost, etc. And so let's assume that they're gonna pay out those $1 million. So you as a 1% shareholder throughout the whole year get $10,000 given to you as the shareholder. Now, this is distributed over a 4-month period. So it's $2,500 and then etc, etc, etc. And it compounds every single quarter. So now that you have more money, the second quarter, you get more and more and more, you see. And so that's very important to keep in mind. Now, I hope you understand the basics of a stock. It's a small piece of a company that you're buying into because you believe in the stock, and also the company will pay you a dividend. Some companies, not every company, and those dividends will accumulate over time and snowball, and it's called the compound effect. And the compound effect essentially is that your money will grow and grow and grow and grow, especially when dividends are reinvested, and it'll kind of be like a snowball that just keeps getting bigger, bigger, bigger as it goes down, right? So I hope that gave you a brief understanding of what a stock is. Let's move on to the next subject. Okay, now it's time to overview the types of investors. So there are about 4 different types of investors, and the first investor is a trader. Now, what a trader does is they say, let's say they like, we're gonna use Apple pretty much this whole time, okay? So let's say they like the company Apple, and then Apple's earnings are coming out the next day. So they'll buy Apple the day before, assuming that Apple did well in that period of time. So they're gonna buy a little bit of Apple at this time, and they're gonna sell it as soon as it's up whatever amount that they think they can be up. So they'll trade it, and they keep doing that over and over again every single day, every single week, etc. Now, that is one style of investing, which I would personally not recommend because it's a lot of risk, and it's not even high risk, high reward, because to play these moves, you're probably not going to do well, especially if you're just starting to invest. It's better to learn throughout time and starting with lower risk things, and then as you build your knowledge, maybe you can start trading here and there with a small piece of your portfolio. Next is a growth investor. Now, a growth investor is someone who essentially invests in a company that they truly believe in, regardless of the company paying out a dividend or not. They just believe in the company a lot and they invest in them over and over and over. Every time it dips down a little, they buy a little more. Dips down a little, they buy a little more. And they're just letting it go out for a long time, and they're just gonna keep investing in it. Okay, so that's the next form of an investor. Now, the third one is a speculator. This is what you do not want to be, unless if you're okay with kind of gambling. So a speculator, essentially, you get all your money and you're like, okay, I think GameStop's going to the moon, and you buy all into GameStop and you hope that it goes up with no real grounds on why the company will do well. This I do not recommend, although if you decide to do this, that's on your own account. However, I personally do not do this, and I will never do this. Next is a dividend investor. A dividend investor looks for companies like Coca-Cola. Coca-Cola pays out about a 3% dividend, which means that for every share of Coca-Cola you own, you get paid 3% over the whole year. And that's apart from how much the stock goes up, which are completely separate things. So that's a dividend investor. You outline your whole portfolio to own stocks that pay you every single month, every single quarter, every single year, a certain amount to own them and just hold on to them. So those are the 4 different types, and my personal type is kind of a mix. I'm kind of a mix of a growth investor and a dividend investor. I am only in my growth positions now. However, I am doing my analysis on some dividend companies just so I can have a better diversified portfolio and get paid dividends every single quarter, every single year. And it is a good way to measure your risk and make sure that you're not over leveraged in one place. So I hope that helped, and we're gonna move on to the next subject. This next subject is where and how do I buy stocks? So first we're gonna go with the where. Where do you go to buy stocks? So you go to a brokerage, and now we're gonna outline the different ways you can buy stocks. So there's something called a Roth IRA. A Roth IRA you can start as soon as you're at the age of 18 or below 18. If you're doing it with your parents, you can set it up below that, but that's for a whole different video. So a Roth IRA, you set it up and then you invest in a Roth IRA, which all it means is that you're buying in like a bubble, right? So in that little bubble, you're buying stocks within that bubble. And you can only contribute up to $7,000 a year, which is kind of the bad part. However, the good thing about that is that you can, as long as you sell over the age of 55, I believe. If not, I will correct it while I'm editing. But over the age of 55, you can sell your stocks tax-free, as long as you hold them to that period of time. When you go to retire, if you go to retirement at that age, then you can sell at that time and it will be tax-free because it's already taxable income that you're putting into there anyways. So it will be tax-free capital gains, which capital gains just means the money that you made on your initial investment. So that's the good part about it. And then if you're married, you can put in $14,000 a year. Okay, and so next is a 401k. A 401k tends to be given by an entity like your boss, like the company you work for, and that just means that you're going into it, but it's taxed at that time. However, you're paying less right now, but you're gonna have to pay tax when you sell. And so that's different. I mean, I would not suggest a 401k. I would definitely suggest a Roth IRA or a traditional IRA. And so next is just a standard traditional brokerage, which means you just go on an app like Robinhood, Webull, TD Ameritrade, M1 Finance, or you open up an account with whatever bank you work with. And so you set up an account there, and that means you still have to pay taxes on that, and you'll have to pay capital gains taxes. However, the good thing about this is that you can invest whenever and how much you want, no matter what. The only thing is you will have to pay capital gains tax, and I will show the capital gains rates depending on if it's short-term or long-term capital gains. Now the difference is short-term means you held the stock that you bought for under a year, and that's a higher tax rate. And if you hold it for over a year, you pay less taxes on it. And it also depends on your income. There's lots of variables. However, I will just put up the graphs here so you can understand better. Okay, now we're gonna move on to the next subject. I hope you got a good picture of what is needed and where and how you buy stocks. How do you determine what stocks you want to buy? Now, this is a big thing. So I would personally suggest for anyone who doesn't want to take on a lot of risk, you buy something called an ETF, which is basically just a traded fund. It basically, you can get something like VOO, and that tracks the S&P 500, which is a tracker of the top 500 companies in the United States. This mitigates your risk and definitely allows you to not have to be stressed about it and not have to worry about doing a bunch of analysis if you don't have the time for it, or if you just don't want to do it. So this is a great way to invest, as you just put however much you want to put every month, every day, every week, whatever it is, and that allows you to just buy into the VOO, which is the S&P 500, as I've already said. And so by buying into this, you're buying into the top 500 companies, and over time, it's known that it does very, very well, and it just keeps going. And as long as you don't sell on those dips, because the economy does reset a little bit, it does pull back, but over 30 years, it's been known to be everything else. However, the thing about that is that you're taking on very low risk, and you're guaranteeing yourself around a 6 to 10% return, usually averaging around 6 to 7%. And so the thing about this is you're not going to get the crazy returns that you might want to get, only 6 to 7%, which still outpaces inflation. And inflation just basically means that if I have this $100 bill, right, and I have that $100 bill and I put it underneath my pillow, 10 years later it's going to be worth 20% less, because inflation runs at about 2% per year. And so you're going to have your $100 in 10 years, it's going to be worth $80 of buying power. You're not going to be able to buy the same amount of stuff as you did 10 years before, which we can all see that when you go to a grocery store, things get more expensive as time goes on. And so I hope that helped outline all this. And buying ETFs is a good way to buy into stocks, as buying into ETFs allows you to mitigate your risk, and you don't have to do too much analysis. You just have to know that what you're buying into a little bit, which is buying into the S&P 500, which are the top 500 companies in the United States if you're buying VOO. And there are, now if you're buying single stocks, which is more risky, you need to learn a lot more. Now, the companies I personally invest in are only 3 as of the time of this recording, which is CCIV, or Lucid Motors, Coinbase, and Tesla. Now, these 3 companies I personally love and I have great conviction about, and I feel like they will do well in the next decade, next 2 decades, next 3 decades. So I will continue to invest in them, and I love these companies with all my heart, and I think that they will be great. But for this, I've had to do hours and hours of learning and hours of research just to figure out if I really want to be in these companies and why I want to be in these companies. You kind of have to put yourself in the headspace, like, if I were in charge of this company, would this company be great? Like, how can this company be great? What is that outline? What is their blueprint? How much money are they making? Are they making money yet? How will they make money if they're not making money yet? And how long have they been out? What are their plans? Why are these their plans? Who's working in the company? Why are they working there? Are they important to the company? Do they have the right people on board? Do they have the wrong people on board? You need to ask yourself all these things, and this will allow you to mitigate your risk. However, there is much higher risk when you're buying single stocks as opposed to buying an ETF like VOO. And so you do need to remember this. And so you need to know what you're investing in. That's very, very important. You need to know what you're investing in and why you're investing in it. So let's move on to the next subject. Really quick, we're going to touch on my personal experiences with stocks. I first started trading stocks a few months ago, and I was just seeing that the pandemic was going crazy, and I was like learning about it. Just on YouTube, videos popped up, and I started learning, and I was like, whoa, this is interesting. I started talking to my parents about it, and they were cool with me starting on my own. So when my birthday came around, I decided finally to start investing around September. Started investing, I bought airlines and things that I thought would recover during the pandemic. Now, as time went on, I started kind of as, I'm gonna hold long term, but when you really start, you get panicked and you don't have the best mindset. And so as time has gone on, I went from being a trader to speculating, which cost me a lot, trying to play GameStop, and your ego gets really big and you get really gambly instead of taking realized risk, and you're taking irrational risks that you shouldn't be taking when you trade and when you speculate. So after I got over those kind of phases, now I've kind of gotten to the point where I am today, where I'm investing in long-term companies that I truly believe in, that have real grounds to believe in, and that I do a lot of due diligence on in order to make sure that they're good companies that are going to do great. And that's kind of where you want to end up, where you go through your kind of phases where you messed up, where you're learning, and then after those mess ups, you kind of get to a more disciplined place where you're really investing in companies that will have good growth over time, or where you're just investing in a simple index fund. Then in that case, you won't have these mistakes. But if you want to buy single stocks, you probably will have a couple mistakes. However, it's a great learning experience, and I love that it happened. Now we're going to move on to other YouTube recommendations that you should watch and books that you should read that will help you learn more. So some great channels that you can watch, apart from mine, of course, is Meet Kevin, Graham Stephan, and Andre Jick. They're all pretty long-time investors. They are all multimillionaires. However, they are very relatable, and they talk in clear and concise sentences, clear and concise videos, and they outline what they're talking about in a simple way so everyone can understand. And Meet Kevin, I feel, is a little more difficult to understand because he doesn't really go over the basics. However, if you go to Graham Stephan and Andre Jick, you can learn more about the basics if you just look up the channel and look up basics on stocks and stuff like that. And you can start learning as you watch these channels. And now, a favorite book that I would definitely recommend is The Intelligent Investor by Benjamin Graham. Amazing book. It will really change your perspective and outline everything that there is about investing and why you can't let your psychology take you away and let it control what you think about stocks and how you're buying stocks. However, you do still need to do a lot of due diligence. However, this book is a great start to investing. So I hope you guys did enjoy this video and this helped you understand how to start investing and helped you kind of ease the pressure and the pain of like learning and all these crazy things. And I hope I gave you some decent sources to get started with investing. Now, sorry, I had to put that down. Now, there are some good brokerages to start with. I will leave 2 brokerages down below, which are Webull and Public. The good thing about Public is that you can invest however amount of quantity into any company you want, and you'll get up to $50 for free just for signing up. And that's what I did. I signed up with it. I got $5 of Tesla, but it's free money, so I'm fine with that. And so with Public, which is the link down below, you'll be able to sign up and get up to $50 of a free stock of your choice. And you'll be able to invest as much as you want, as little as you want, whatever you want. If you want to invest $100 into Tesla, even though it's a $700 stock, you can do that, as opposed to Webull, where you can only invest buying the whole share, which is not that great. However, I do love Webull as a brokerage, and they offer great services. It's wonderful as well, and it's more technical. And so I'll leave the link for that one down below as well. However, know that with Webull, you can only buy the full share of a company. However, you do get 2 free stocks when you sign up with the link down below with Webull, which can be valued up to $1,850. When I first signed up, I made I think it was 35 of free stock, which is not bad. So I hope you enjoyed this video. Leave a like if you did, and subscribe if you are new. Thank you so much, and I hope this helped you gauge a good perspective on stocks and how to invest in them. Thank you so much, and I'll see you in the next one. This was Kev's Mindset. Good luck investing.